Good afternoon, and thank you for joining us once again. With us today is Simon Gergel. He is head of UK equities at Allianz Global Investors. Mr. Gergel, thank you for joining us today.
Alex.
Okay, the current market backdrop. There's big fear in the market as regards the situation on Capitol Hill, stateside. A lot of people are talking about the debt ceiling, the deadline, the 17th of this month. But that's not exactly correct. What is the situation there?
Well, the 17th is the deadline for the negotiations, but it doesn't automatically trigger a default on US debt. The first interest payment is on the 31st of October, and they could probably meet that payment. So they could technically go past the 17th without defaulting on their debt. However, I think markets would get extremely nervous if we got towards the 17th and beyond it without any resolution.
Okay. How intractable do you think the debate is now on Capitol Hill? It seems very polarized, perhaps more so than in the 80s, or am I mistaken?
Well, I don't know about more so than the 80s, but it is very polarized. I mean, the whole sequestration issue is a dangerous sort of reminder of how polarized the debate is. Sequestration, if you remember, was put in to be so unpalatable that the Republicans and Democrats would come together and agree some other way of cutting the spending plans, and they didn't. So you do have this sequestration, which cuts every part of the budget equally, which is clearly not a very sensible way to run the country. So, I mean, I don't have that much confidence that they will get to an agreement before the very last minute.
So there is certainly a definite risk that something could happen, even if small?
There's a risk that it could go on to the 17th and even a little bit beyond. I suspect markets will react so strongly then that they will ultimately come to some sort of agreement. I don't see the US defaulting on its debt, but who knows? I mean, a lot of things have happened since the financial crisis, which we thought were impossible or very unlikely, like US losing its AAA credit rating, quantitative easing, money printing. You know, there's lots of things which seemed unthinkable have happened.
Okay. As far as the investment funds which you run at Allianz, your investment style, how would you define it? Give us a little bit of color, a little bit of flavor.
Yes, well, I'm a fundamental, value-orientated contrarian investor. So if I
Contrarian?
Yeah, so if I explain what that means, fundamental means spend a lot of my time, most of my time, trying to understand businesses, the competitive position of a company, the barriers to entry, the protection of a business, the strength of its balance sheet, financial ratios, you know, profits and so on, and cash flows, and the management structure. Okay. And we've got a large team of analysts and our own market research company to help us do that.
I see. How many analysts are on the team?
Well, in Europe, there's about 25, 26. Wow. And we've also got our own market research company as well. So that's the fundamental side. The value side is we believe that the price you pay for an asset has a very strong link to the return you get. So if you buy something cheaper, you tend to make a better return. If you buy a company with a higher yield, you tend to do better on average.
As far as financial ratios, which do you prefer? How do you screen for stocks? Please, a little bit more detail.
Well, the main, if I had to choose one financial ratio, it would be the cash flow or the free cash flow that the company generates. Right. Cash is much harder to manipulate than revenues or profits. You know, there's a lot of ways of different accounting policies you can use to manipulate profits and revenues, but cash is a pretty true measure, and cash ultimately pays for the dividends and allows businesses to reinvest for the future. So if I had to look at one measure in particular, it's the cash flow.
Cash is king.
Cash is king.
Okay. In the markets, there's a certain amount of volatility. There are a certain amount of jitters and nerves, different opinions when looking out to the medium term. Some people are optimistic on U.S. growth, a la Goldman Sachs. Others say that U.S. economic growth is zero bound. Where do you see value within this context in the markets?
Yeah, it's tricky because you've had quite a strong market recovery in the last 2-3 years, whilst economic growth has been pretty lackluster. So valuations have risen generally. We see pockets of value in certain areas. We particularly like the big oil companies. They've tracked sideways for 2 or 3 years and are really on quite cheap valuations, good dividend yields, strong cash flow, very robust businesses. And we also like specific recovery situations. We're looking for industries where you're at the turn, where the industry is really quite depressed, where valuations are low, and that comes back to this contrarian theme.
Okay, what might be an example of that?
Well, UK construction, there's a company called Balfour Beatty, which is one of the largest UK construction companies. They've also got very significant assets, infrastructure assets they own. They've got a US construction business, which is doing well. They've got an international engineering consultancy business, which is strong. But the UK construction bid is very depressed, and that's where there's a recovery potential. I
see, okay. You were telling me before, or rather, we were talking about Rio Tinto. A lot of managers are keen on Rio Tinto. You do not seem to be as keen. And as far as mining, at the moment, you are perhaps less keen than others. If you can perhaps run viewers through this.
Yeah, well, we've got very modest holdings in mining. We don't own Rio Tinto. To take a view on the mining sector, you have to really have a view on iron ore in particular, especially for Rio Tinto, where it makes 65-70% of its profits. Iron ore is dominated by Chinese demand, and therefore you have to have a view on the Chinese steel demand ultimately. We know there's a lot of iron ore production capacity growth coming out of Australia in particular, but also out of Brazil and other places.
Right.
And so you need Chinese demand to remain robust into the medium term to justify current iron ore prices.
Okay.
And really there's just a lot of doubt about that. So whilst current forecast, current valuation looks quite modest, we don't have much confidence about the strength and the consistency of that Chinese demand into the future.
Okay, and then BHP, nevertheless, you do like BHP. How come?
Well, it's more diversified, so you're taking less of a view on iron ore, more of a view on oil and other commodities. And we, in particular with oil, we're much more relaxed about the outlook for the oil price and oil earnings in the medium term, because it's much more diversified. China is a much smaller consumer of oil in the world market. Oil demand is much more broadly spread, and actually is very closely linked to the price. So if the price of oil goes up, people stop driving as much, and if it goes down, they drive more.
Okay, I understand that. Utilities. There's been quite a bit of market chatter lately. There was a proposal from Labour to tighten, strengthen, in the negative sense, regulation of energy utilities. What is your view on that? Is it feasible? How might it affect stocks? I think you have some interesting insights in this field.
Well, yeah, I mean, Ed Miliband, leader of the Labour Party, has proposed a price cap for, I think, 15 months or 18 months when he comes into, if he comes into power after the next election. It's going to be very hard in practice to cap prices, because so much of the electricity price is not the profits that the companies are making. It's pass-through of costs, it's pass-through of environmental costs, many of which Ed Miliband put into train when he was Energy Secretary not that long ago.
Right.
So it's possible that by cutting back some of the environmental costs, they can do a deal with the industry whereby they can keep prices under control and absorb some of the other cost increases coming through for a steady price. But I think to just cap prices sends quite a difficult message to the industry, would make investment in the industry by the companies, quite difficult. Companies will become much more risk averse, and you're already seeing signs of that. So who would want to build a new power station today with fears about where electricity prices might be in the future?
Okay, so when you say perhaps in the short term, we might see some weakness in the share price of some of these stocks, but in the medium term, it should blow over?
Well, we've seen some weakness already. I think where we go in the medium term depends on A, I suppose, how likely Labour are to win the next election, and B, how feasible these proposals are likely to be in practice, and whether there's some sort of quid pro quo. So it's quite hard to call, really, whether in the short to medium term this is an opportunity, or whether shares might trade off more than that. But long term, we see value, and in a perverse way, the less power stations that are built, in the very long term, the more positive it is for those generators who do have power stations, because the price will end up higher, probably.
Okay. Perhaps if you could please share with our viewers, if it's not asking too much, one or two other investment ideas which you are keen on that Allianz likes?
Yes, I mean, we quite like industrial property. It's a bit of a niche, whereas sort of prime city properties like this one have been re-rated. Yields have dropped, and investors have recognised that a good building in a prime place is quite an attractive asset. Industrial property has lagged behind, and we see an opportunity there for a re-rating. We see, as economic demand grows, some of that space being taken up.
Specific names of companies in there?
Like Segro, which used to be called Slough Estates, or Hanstein Holdings, which is another one.
Okay.
Yeah.
And anything else?
Yeah, I mean, we still see value in the media companies.
ITV?
Not so much ITV. I mean, we own United Business Media, which is one of the biggest exhibition companies in the world. 40% of its profits come from emerging markets, where exhibitions are growth industries. The big exhibitions are very profitable, because they're the leaders in the industry, tend to attract the key participants. and the big tend to get bigger in exhibitions.
Right.
The cash flow is really good, so you get a lot of exhibitors will pay 12 months in advance to have a position for next year in the exhibition. And so it's quite a good business model, very high return, and UBM have got a big exposure there.
Fantastic. Mr. Gergel, thank you very, very much for your time. We know
Thank
you're a
you.
very busy man. We hope you'll join us again.
I'll be delighted to.
Thank
Thanks,
you very
Alex.
much. And unfortunately, that's all the time that we have for today. But again, thank you for joining us this afternoon, and we hope to have you with us again next week. That's all from us here at Digital Look TV in London. Goodbye.